All right, hello everyone, and wow, what a week we just had in the stock market. We've seen volatility levels increase and we are seeing tech stocks decrease. Is this a summer stock market crash that's here? Or are we just going through a typical stock market cycle, gearing up for another leg higher in the back half of 2026? I'm really excited about today's video as it will be much different than our typical videos. So be sure to let me know in the comments and, of course, show your appreciation by smashing that like button down below. And with that, let's jump right into it. So hopefully by now you could see on your screen a portfolio. This is the portfolio performance update that I give to all of my Edge Plus subscribers. Again, you'll get all of the trade alerts that I'm doing on a regular basis, but on a monthly basis, we put a full report talking about stocks that we've added to, stocks that we've sold, why did we sell them, and just how did the portfolio do overall. So as you can see right here, in 2026, the portfolio right now is up around 16.5%, 16.7. The month of June, we were down just a smid by 0.6%. But here we are, and this is an update of that portfolio as the point of this video right now. So as you can see, we've gone up another notch here up to 18.3%. So that's through today at this video here on July 17th. So what are we going to talk about here in today's video? We're going to talk about S&P 500 valuation. Where is the stock market right now? Are stocks crashing, or am I looking for buying opportunities? Is there plenty of buy the dip opportunities right now? So we'll talk a little bit more about that. Should we be rotating into different sectors? And then towards the end of the video, we're going to be going through 11 stock reviews. Very popular stocks, giving you my grade, showing you our edge score, and things like that. Of course, always do show your appreciation by smashing that like button down below. So let's jump right into it, beginning with the S&P valuation. So this blue line you can see right here, that's the S&P 500 valuation, and the darker line is going to be EPS expectations. So over the course of the next 12 months, we can see that EPS is sitting around $375 for the S&P 500. As of the end of Friday, the S&P 500 closed at 74.57. So just doing a simple forward PE ratio, right now, the S&P 500 trades at 19.8 times. That's actually not that bad. And some might look and say, well, Mark, the 10-year average is closer to 19. So really, the stock market is overvalued when you're looking strictly at the S&P 500. And I would push back on that because the S&P 500 looks very different today than it has over the course of the past 10 years. There's many more tech stocks. Tech stocks dominate the top of the S&P 500. And when you're at the top, you carry more weight. These are faster growing companies with higher multiples. Hence why we are seeing a higher multiple for the S&P 500 over the course of the past 20 years. It used to be at 15, then it was the average of 17, 18, and now we see it closer to 19. For me personally, based on the mix of the stocks that we have at the top right now, Nvidia, we have Broadcom up there, you have the likes of Apple, Microsoft, all stocks that for the most part are growing relatively fast. I mean, you got Tesla up there and Micron now that's up there and things like that, but they have much higher multiples. So when those are the top 10 positions, or if you look at the top 20 positions, yes, the S&P 500 is likely going to have a higher valuation. So what is my fair value? I get asked this all the time inside of my investing community, and my fair value for the S&P 500 on a forward PE ratio is around 20.5. That's where I think is a relatively fair based on the growth that we're seeing in the market right now for the S&P 500 and particularly tech stocks, and we'll talk more about that here in a second. So really, I'm looking at a stock market that might actually be slightly undervalued given the pullback that we have seen in many of these names. So with that being said, let's jump over to this slide right here. And this is taking a look at the year-to-date sector performance. So 11 different sectors make up the S&P 500. At the top, you can see it's a pretty broad split. At the top, you have energy, technology, industrials, real estate, and materials. 5 sectors that are outperforming the index as a whole. But what I did in this research, before this video is I went back and looked and said, okay, we're up 10% year to date right now through, we'll call it mid-July. Where were we at that same point in time in 2025? And actually, we were only up 7%. So 2026, although it's been a lot bumpier, is actually further ahead than where we were in 2025. And if you look further down on your list, you could see the only sector in the red on a year-to-date performance is actually consumer discretionary. And that's where I believe that we continue to have a jobs market that is okay. We continue to have a very resilient consumer. I think this is an area where you can find a lot of opportunity. So that's year-to-date sector performance. Now let's take a look here at sector performance over the course of the past month, because this kind of gives us a better indication on where are investors of late, where have they been putting their money. And as you can see here, there's 7 different sectors that have outperformed the S&P 500. That shows that broadening that's been talked about all over social media, the internet, CNBC, Bloomberg, wherever you get your content. We have heard about the broadening that's been taking place in the S&P 500. But the good thing is the fact that, well, while we're broadening, while we're selling a lot of tech stocks, which you can see is down 4.3% over the course of the past 30 days, money is going into other sectors. It's not like money is going on to the sidelines. Money isn't coming out of the stock market because we continue to see financials up 6.5%, healthcare up 6%, energy still up 3.5%, utilities, real estate all up 1 and 2% right there. So there's still money that's being invested. Profits are being taken and it's been moving elsewhere. Is that a trend that I expect to continue over the course of the remainder of the year? No, because I'm still bullish on the AI theme. I still believe that we are in the early innings of the AI theme. And I still believe you want a solid exposure rate inside of technology. So when we get these broadenings, that's just part of the cycle. That's okay. And that's why it's important to have a diversified portfolio. And a diversified portfolio doesn't mean we're even across all 11 different sectors. It means that we have a broadening in our portfolio, that maybe we have some exposure to utilities, some exposure to materials, but you can be overexposed to technology, communication services, and things like consumer discretionary, if you will, if you are a growth investor. That's the way that I kind of manage my portfolio as a whole there. So what I want to do now is I want to take a look here at the year-to-date performance for not only the S&P 500, but we're going to compare it to the NASDAQ. The Dow Jones isn't something that I look at all that much. I don't think it's all that important. It's made up of 30 different stocks. It's a price-weighted index. I care more about what's happening in the S&P 500, what's happening in the NASDAQ, and I actually also threw in the NASDAQ 100, which is also known as the Qs. And we could see for all 3 of these, and again, it's tech-heavy, of course, in the NASDAQ. It's very tech heavy in the triple Qs, but the S&P 500 over the course of the past, call it 15 years, has really evolved from industrials into this tech heavy as well. So just having an S&P 500 index fund at the top and matching it with the triple Qs and other growth stocks, you could be way overexposed to one particular sector and have no real clue. But what we could see with all 3 of these that we're looking at is they all peaked at the same time. They all peaked in late May, and it's really been a battle since then. It's been a solid pullback. So on a year-to-date basis right now, the NASDAQ is leading the charge, up 13%. The NASDAQ 100, I should say. The regular NASDAQ index is up around 10%, and the S&P 500 hovering right around that 9 to 10% threshold there. So where are we, though, over the course of the past month? And that's really been the story of the market right now. And that's caused a little bit of chaos and some nerves that have gone increased. Especially, I hear it all about it inside of my investing community of folks saying, Mark, is it time to get out? Is a bigger crash coming? And I like to think of this as just simply a rotation. Look at these as healthy, because we can't just go straight from bottom up to the top right there. That's just seemingly not the way a healthy market moves. We need pullbacks. We need to be able to reset. So I look at this as a very healthy move. Does that mean we're not going to have any more volatility? Does that mean that there's no further downside? Absolutely not, because the summer months and what's right around the corner here in about a month and a half, it's going to be the month of September, which the month of September is historically the worst performing month for the S&P 500. And now when you mix in a midterm election cycle, which is typically not great for stocks around that time period leading up to the elections, which happen in November. So the months leading up to it, that's also not a great time. So seasonality wise, not a great time for stocks. So don't expect a big catalyst to jump higher here and start hitting all-time highs by the end of July. That's just not in the cards. But what you can do is start to accumulate cash on the sideline, start building your watch list. That's why here in a second, we're going to look at 11 popular stocks. We're going to look at the score that we have inside my community, and also I'm going to give you my personal grade. So, but over the course of the past month, you can see the S&P 500 down around 50 basis points. The NASDAQ, though, down around 4%. And then the NASDAQ 100, that's going to be your NVIDIAs and your Microsoft, all growth conscious stocks, down, nearing that 6 to 8% just over the course of the past month there. So what has been the real problem? It's been the memory trade of late. The memory trade on a year-to-date basis, though, is what has been leading this particular market. So looking back over the course of the past month here, you could see that the memory sector is simply in a bear market. It's not down, a few percentage points here. It is down 31%. The memory trade is what got this rally going, and the memory trade is what has stalled a lot of growth stocks in general, and there's been a trickle-down effect in all of this. So let's look at some individual stocks in the memory trade here. So again, all of them seemingly in a bear market here. You got SK Hynix, which they just went public, so they've only been public for about a week or so here. They're already down about 10%. You have Micron down 25%. You got Seagate, they're over 25%. You got Western Digital over 35% in the red. And then you got SanDisk bringing up the rear, down nearly 40%. This is just looking over the course of the past month that we are talking about here. So some major losses inside of these particular memory stocks here. Now, there's profit taking that's happening, but there's also some fears about what's going on. This is the DeepSeek moment we are starting to see inside of the memory trade. But what do we see with that? It was an overreaction then. Is it going to be an overreaction now? I believe so. Doesn't mean there's not further downside here, but I believe you will see these names higher than they are right now by the end of the year. Again, I'm not looking to invest hoping to get a gain here in the next week or two or in the next month. I'm a long-term investor looking for great entry points in high-quality stocks. I want to buy high-quality assets at great valuations, and you're getting a chance here in some of these memory stocks here. So this is an interesting note that I came across in the research for this video here today, is the fact of how big of a weighting semiconductor stocks are now inside of the S&P 500. So as you can see here, semiconductor stocks now account, this is from bar chart, for 20% of the S&P 500. In general, 20% of the entire S&P 500 is made up of semiconductor stocks. That is an all-time high, and you can see that wave. I mean, this is something that if you just go back to 2020, we're talking about something in the realm of 5 to 6%. Now, near 20%. That is pretty wild there. And you could see all of the other sectors now account for 80%, whereas if we go back, 10 years, that was closer to 98%. So a wild turn of events, just showing you this whole AI trade. And a lot of folks talk about bubble. I don't want to get into that right now. That's for another video, but I definitely do not think we're in fact in a bubble. I think we're actually in the early stages of this AI revolution that we are in fact going through. So some key metrics, heading into this key earnings season right now. This is something we need to talk about. So we've talked about S&P 500 valuation trading at 19.8 times. I personally think we're around the fair value, maybe even slightly undervalued. Now, a lot of folks that you'll listen to today, they'll say, they'll talk about the bubble. They'll talk about a stock market being overvalued. I'm not in that camp. I'm in the camp that, number one, we're not going to have rate hikes, so that's going to be a tailwind. But the other big tailwind is going to be this right here, the earnings growth. If we can keep inflation under control, and I think that there's a bit of transitory to that as long as the escalations don't happen over in the Middle East, which we're starting to see those, so that could kind of bring those fears back. But earnings growth, stock prices tend to follow earnings growth. We can't just jump, we can't have stock prices rising without the earnings growth. That's when we're really getting into the bubble territory. But right now, the proof is in the pudding right here. So based on the companies that have reported so far, you can see that's only about 10% of companies. We're still early in this earnings season. 88% have surprised to the upside. So we're off to a great start here, but the big dogs are coming around the corner here. But look at these Q2 expectations for S&P 500. We are talking about mid 20% growth, earnings growth that is expected for the S&P 500 year over year in Q2. That is just fantastic. This would mark the second straight quarter of earnings growth above 20% for the index. And that is just seemingly uncalled for, or not uncalled for, but it's just not something that happens very often, is what I should say. And this is what you need to be excited about when looking at valuation. This right here is what we're talking about in terms of tailwinds for the S&P 500. So this chart right here kind of gives you an idea. The green bars are showing earnings growth. Again, these are by quarter, and you can see the fiscal year we're talking about. And then it compares to the prior year. The orange bars are the prior year. So Q1 of 2026, last year we had 11.6% growth. Q1 of this year, we were at 24.7% growth. Now here we are in Q2 of 2026, where last year we had the highest growth of all quarters. We were seemingly just a tad below 12% earnings growth, which is fantastic. But look at the numbers that are expected to be put up this quarter. 25% growth, mid 20% growth we're talking about. If it's anywhere close to the 20s, that is seemingly going to be fantastic right there. And that's where you can look at something that is trading what appears to be a higher valuation, but the earnings are there to back it up. And if the earnings come in that strong right there, that's seemingly going to bring valuations down because of how fast the earnings are growing. And you could see the months to come, 21% expected in Q3, 23% expected in Q4, and then we start to kind of tail off. Why? Because, well, the comps are going to be that much more difficult, because look at the numbers that we were putting up here in 2026. So that is a tailwind, but at the same time, some can look at that and say, well, the bar is high. And yes, the bar is definitely going to be high. So if companies don't beat expectations here, and the real focus is going to be on guidance, if guidance isn't great and we don't see increases in guidance, then we could see stocks that double beat, but in fact fall on their earnings there. So look at some of these pullbacks. This is a tweet I put out on X. And again, if you don't follow me on X, make sure you give me a follow. That's at dividend_dollar. Investors have loved these stocks. Very popular names right here. Again, I'm not involved in all of them. I tried to put a note there for the ones I'm involved. But look at the likes of CoreWeave down 6%, Rocket Labs, Iron both down 55%, Marvell, Nebius, ARM all down more than 40%, Bloom Energy, Micron, Broadcom, Zeta Global, and Taiwan Semi all down more than 15 to 20% right there with those last names that I mentioned. And these are from their recent highs, which wasn't all that long ago. CoreWeave, not a stock I own. I utilize options with it. Rocket Labs, not a stock I own, but I utilize options with it. Iron, I own both of them. I own the shares, and I also utilize options. Marvell, I own. Broadcom, I own. Zeta Global, I do options with, and Taiwan Semi is a name that I own and looking to do some options with as well. Before we continue, let me tell you about one of my favorite portfolio trackers, which is Snowball Analytics. Snowball Analytics is fantastic for all investors, but especially dividend investors, as it not only gives you a snapshot dashboard of your portfolio, they can break it down by sectors, class, region, you name it. But I really love the dividend dashboard, which helps keep me on track towards my dividend income goals and has a great scoring system to evaluate your specific dividend stocks. Right now, you can try it out completely free for 14 days when you use my link down in the description below. Give Snowball Analytics a try today. All right, with that being said, now let's jump into the 11 different stocks, giving you our edge score, what's inside of our proprietary valuation website, but also my grade for these particular stocks that we're going to look at. And these are very popular stocks. Many of them are placed in the AI theme per se. So we're going to look at them from two different angles. Is it time to buy the dip on them? Or is this a market crash coming? Or maybe they're just going to trade sideways. Doesn't necessarily mean they're going to crash, but 11 stocks to review and grade. And let's get started first with a couple of names that have already reported. And the first one's going to be Netflix. Netflix is a stock that I do own shares with, and I also have some option trades on. But we could see that it was a mixed bag here. So the company missed on revenue during the quarter, but they beat on EPS. And if you like these write-ups here, we do these for all of the stocks that we follow inside of our investing community. If you want to check that out, there's a link down below. But you can kind of see the revenue trajectory and what the EPS has been over the course of the last quarter and some of the takeaways here. But the things I want to hone in on here is operating income, as you can see, was up 11%. That's year over year. Net income was up 9%. The operating expenses and the cash flow, that gave us some reason to be concerned a little bit. But if you look down here at the bottom in our edge notes and what caught our eye, you could see a note that we mentioned here. So free cash flow came in at $1.5 billion during the quarter. This was down from last year's Q2, which they generated nearly $2.3 billion. But this was impacted by a higher cash tax payment. So if you recall, the company was acquiring Warner Brothers. That deal ended up being terminated, not by Netflix, but by Warner. And as part of the deal, they had to pay a large sum of money to Netflix to terminate the deal. Well, that's going to be a gain to Netflix because they got paid cash. There's going to be tax on that particular gain, and that's what they're referring to. It was a timing difference when it was due, when they got paid, and things like that. So that resulted in a less than stellar free cash flow number, but it was a one-off item. But the thing that I liked was the fact that if you look at that second line here, is the fact that management remained on their target of generating $12.5 billion in terms of free cash flow. So that's what I like to see. As you know me, if you followed me for any amount of time, you know that I love looking at companies with strong free cash flow. Kind of a mixed bag, didn't have big expectations going into it. So with that being said, let's jump here and look at Netflix right here. So as you can see, the stock is down 43%. And what you see on the right side here, this is our edge score. So if you're part of my community, you get access to our valuation website, which you can look up any of the stocks inside of our database, which we have hundreds and thousands of stocks in there. You're going to get an edge score, and all of it's going to be based on valuation, future growth, the financial health of the company, and past performance. Now, if the company is a dividend-paying stock, that will go into the equation as well. So it's a score of 0 to 100. Anywhere 70 plus, I usually equate to a very solid score for Netflix. But when it comes to this particular company, I just don't see a ton of catalyst higher. I love what they're doing with live sports. I love what they're doing in terms of the ad-supported theme and how fast that is growing. It's a high-margin business as well. But I think it's going to be a prove me story. So I think it's still going to kind of go sideways. Obviously, today didn't have a great day, down 7.8% after earnings. So I'm not going to give it a terrible score. I don't think it's a C. I think it's one that can and should be held. But it's just going to have a solid B. Nothing that's overly excited when it comes to Netflix there. But on the flip side, though, let's look at TSM here, which is Taiwan Semiconductor. They actually reported a very solid report, and as we can see at the top of your screen here, a double beating slightly on revenues and a solid beat, though, on the EPS side, up 13%. Revenues and earnings are just continuing to grow. It's like a stair ladder, and that's what we love to see. Year over year, up over 30%. Earnings up nearly 80%. That is all stuff we love to see. I like to hone in on operating income here, growing at 65%. Net income up 77%. And look at those gross margins, 67.7%. Okay, Mark, well, that's all fantastic. Why was the stock down the 2 days after reporting? And I want to say the issue there was the gross margin was very strong. But when you look down here on the forward guidance side of things, operating profit margin is expected to come in between 56 and 58%. And that was a number that analysts were expecting to be a little bit higher per se. And just that one thing, again, guidance is so much more heavily weighted than the actual results. And I usually tell this to folks that are in my coaching program is it's less about what you did for me, meaning what they just reported, and more about what you're going to do for me. And that's per se the guidance there. So that's a look at Taiwan Semi. What do I give them? I give them an A-. And as you can see, the edge score on our valuation model is around a 74 there. Very strong future growth. And look here at the 2027 EPS growth. They're expected, based on average analysts' expectations next year, around 25%. Right now, you can pick up shares at a forward PE of 19.3 times. And if you've been watching me for a while, one of my favorite metrics to look at, and it's not something I look at for all stocks, and it's not something that should just be looked at on its own and then make an investment decision on. But I love looking at PEG ratios, especially for stocks that have solid growth, at least that 15 to 20% earnings growth, which this company does. We have a PEG ratio of less than 1, which is very intriguing. Again, I give this stock a minus. Now let's move on to NVIDIA. So those are our first two stocks. I got 9 more for you. So as you can see, a very strong edge score at 78. I actually think the valuation score should be, very high here. We're talking about a company with a 2027 EPS growth of 43%. I think that number is actually low. I think they're going to be above 50. This is a stock, folks, trading like it's a consumer staples stock. If you look at the median stock inside the S&P 500, NVIDIA is now trading lower than the median stock in the S&P 500 when it comes to a forward PE ratio. And that is just wild to me. We are talking about not only the largest company, but one of the most vital companies when it comes to everything AI. They have built an AI ecosystem, and far too many folks are just looking at chips here in terms of AI and data centers. But what about EVs? And not just EVs, but all automotives. What about robotics? That's being underscored when it comes to NVIDIA, and I just believe the valuation is insane. I give this stock a grade of A+. I believe it is a must-own, and I actually refer to it as one of the easiest buys in the market right now. Let's take a look here at the charts. So as you can see, the stock has dipped seemingly, and this is the Fibonacci rates we're looking at, so you can see where we peaked out. We have fallen all the way down back to that last key 61% level in terms of those Fibonacci levels. This is going from top to bottom here. So that is going to be a line in the stand for NVIDIA, but that's exactly where it bounced. But not only do we have support from that, you have the 200-day moving average, which I highlighted in red there. That's almost at the exact same level, which is right around that 190, 195 level for NVIDIA. So when it comes to that, where do you think I've been utilizing options in? Selling the 190 and 195 puts on, generating hundreds of dollars, thousands of dollars in profits, in income by utilizing these strategies. And again, if you're interested, you can see off to the right there, on Tuesday, July 21st, I will be launching my 4-week program. You can trade alongside me for 30 days. You get full access to my Options Edge Plus. We're going to be going through 4 educational sessions, which you can join live or get the replays for. It's all down below. You can find more information. There's a link. Seats are limited for this one, folks. This is one that sells out every single time that we hold it. And I will show you the profits here in a second on my goal of generating profits for you. You invest into this program, I want to get your investment back in those 30 days that we're together. So we're going to be sharing a number of ideas, not options that I'm already in, options I'm looking to get in. So you're going to get a firsthand look as we go through that during the 30 days together. So talking about right there, utilizing charts. So that's where we're at with NVIDIA. Let's look at another AI chip stock, which is going to be AMD. AMD is a stock that has just been nuts. So AMD, down 1%, as you can see today, has a score of 66, which I think is fair because valuation has been high. But at the same time, if you look off to the left, AMD is giving you 81% growth next year. Earnings growth of 81%. This is a company trading at a forward PE of 37. If you just looked at that on a standalone basis, folks would say, okay, well, that's pricey. You're getting up in the 40x range. Not for a stock that's giving you 81% growth. Again, that's not the only metric we should ever look at. From an EV to sales perspective, it is on the higher end when we're looking at some of the other chip companies. So not all gravy there, but this is a company that I think has better days ahead. I definitely don't think we're gonna be below 500 by the end of the year. I think we'll be likely at new all-time highs for that one. So looking at the chart here for AMD, again, you got the Fibonacci there. You could see where it fell from, which really started that downtrend. So the first level we're going to be looking at here, that level to watch is going to be that 38% level. So that's going to have us just a notch below 440. Right now we're in the 495 range there. So still, plenty of downside that we could go to. But also, we have this unfilled gap, and that's a bit of concern. That's down at the $400 level, so that's still talking about a good, 10 to 20% drop just to touch the top of that level there. That unfilled gap goes all the way down to 360 though. So that is an area of concern from a technical perspective, which is why it did not get a higher grade than we gave it. Let's look at Marvell, another great chip company here. Edge score of 63. So you can see NVIDIA's topping all of those names out there. 2027 EPS growth at 53%. Forward PE at 30. So on a PE, a forward PE level, less than AMD, more than NVIDIA. But on an EV to sales, I wanted to list these three chip stocks out for you to show. AMD's at a 16x multiple, Marvell at 14, and NVIDIA at 12. So on a PE level, NVIDIA is cheaper. From a cash flow perspective, NVIDIA is cheaper. From an EV to sales, NVIDIA is cheaper. One of the best balance sheets you will find. One of the best leaders that you will find. Strong growth that has continued. And they have an AI ecosystem. That's why I seemingly call it. Doesn't mean I don't like these other stocks. I have Marvell in my portfolio. I have had AMD in my portfolio. But NVIDIA, to me, is just seemingly one of the easiest buys right now inside the stock market. So let's look at Marvell. Again, you can see the Fibonacci's on there. We've had a big drawdown, right around 45% from recent highs. It didn't take that long. It's been a quick 45%. But now, right now, what we're looking at is a very intriguing level. And this has me a bit excited and maybe seemingly wanting to start to jump back in and buying more shares of Marvell. Because when we look here at the technicals, you could see up top we have a low RSI that's sitting right around mid 30s there. So anytime we're at around 30 or below, that's seemingly a potential signal that this is a stock that's looking to go higher on the near term. Looking here at the Fibonacci's, we have that level sitting, not too far below where we're at right now, so that could provide a level of support. This baby blue line that you see is going to be right around that Fibonacci level of 61% in terms of the drawdown from where they were, and then we see a reversal. So we kind of got a double support line there as well. How low can it go? You got the 200-day lurking down there in that 140 range, so that's kind of the line in the sand. But we also have a low MACD that could start to curl back, all setting up for a lot more bullish momentum that could be coming in the near term. Not confirmed yet, but things to watch when it comes to Marvell. Now let's get to ServiceNow, which is probably the stock that I talk about a ton here on YouTube. And I would venture on to say that I've been talking about ServiceNow more than any other YouTuber out there, because this is a stock that I was buying when it was down in the 80s, and I bought more in the 90s, and not afraid to buy in the low 100s either. So this is a stock that I give an A. Just believe a lot of this software sell-off that we have seen, they're just the fears around them are overblown. Is it overblown for every stock though? No. So it's going to be a selective few that you're going to want to pay attention to. But I continue to believe that ServiceNow has mission critical AI software. They are the AI tower or terminal per se. Earnings are expected to grow 22% next year. Stocks trading at a forward PE of around 20.7 times. Again, another stock we're looking at with a PEG ratio less than 1. Things I love to see. Edge score likes it as well. A very high score of 83 there. So how does the chart look for ServiceNow? Again, RSI is kind of in that no man's land in the middle, not telling us much there. But we've kind of been building a support level of higher lows. That's kind of going up and sideways here a bit, but the fact that it's increasing, that's what we like to see. So that's that support level I'm looking at right now, kind of in that mid-90s range. So if it got back down into the 90s at all, I would be buying. We also have a 50-day moving average that's getting set to cross over the 100-day moving average, and then hopefully eventually we'll get back above that 200-day moving average. So a lot to like with ServiceNow from a business perspective, from a leadership perspective, from a valuation perspective, and also from a potential technical perspective here. So here's a reminder on that full stack options investor. Again, that'll be starting on July 21st, and we're going to have 4 sessions, teaching sessions every Tuesday, 7 p.m. Eastern time. You'll get recordings to those. You'll get all of the slide decks, any of the checklists that we go through, and it's going to be hands-on. There's going to be educational pieces, but then there's also going to be homework for you as we dive into actually building out some trades for the next day. And again, my focus is to get your investment back and hopefully profit. That is what we did last time. And in the last full stack options investor that we did just a month ago, In the 30 days, these are the trades that we shared and that we exited as well. So you can see that if you went into each of these trades and just did one contract, again, I'm doing multiple contracts, but it's all going to base on your portfolio. But if you just did one contract of these that we shared, you can see that they generated over $1,200 right there. So very solid, very happy. We had one losing trade, but the idea is to show you all of the different strategies that I utilize, over 10 different option strategies, and then give you some examples to look at that, no, I'm not in them yet, but let's start to look at them. Why did I choose that strike price? Why am I selecting this particular stock? What's the valuation? How do we look at the technicals, bring it all together? That's why it's called the full stack options investor. All right, let's keep going with our stocks here now. And let's take a look here at AppLovin, another stock that I like in the software sector. Not as much as I like ServiceNow, which is why I give this stock a B. It gets a solid edge score over 70, sitting at 73. Very strong margin business here. 2027 EPS growth sitting at 32%. Forward PE at just 20.5 times. Again, we're looking at another stock with a PEG ratio less than 1. If you go back at the beginning of this year, or you go back 12 months, not a lot of these stocks had PEG ratios that were less than 1. Now that they've pulled back, earnings are continuing to increase. That's how valuation makes more sense. That's how we want and when we want to jump on these. So looking here at the technicals, we can kind of see this wedge pattern that's kind of starting to take place. We have support down below. This, though, is proven to be an area of resistance, so kind of going the wrong way there. The $400 level is going to be that line in the sand. That's where we want to see the support level hold up. I believe it will, assuming we don't get some sort of huge escalation over the weekend that just sends all shares going down. But we're looking at an RSI that is low and a MACD that could be gearing up for a bullish crossover there. All right, let's get into some of the big dogs here. Amazon, one of my favorite stocks and one of my largest positions inside of my portfolio. I give them a score of B. Been a solid year. You know, they got up over 270 at one point, dipped all the way back into the 220s. Firmly sitting around 250 right now. Next year's earnings growth, 15%, forward P at 25. Now, the thing that I want to watch with them is they're currently at a negative free cash flow. So heading into this earnings quarter, what is the CapEx budget's going to be? What's it going to be for Alphabet, my largest holding? What's it going to be for Meta? What's it going to be for Amazon? And based on analysts, they believe that those expectations are going to increase. Those forecasts are going to increase. So it'll be interesting that if that's the way it plays out, how are the stocks going to trade there? So not one, I have a large position in it, not one I'm looking to jump in right now. So taking a peek here at the technicals, we could see when that RSI gets around 30, that was the time to buy. We had RSI at 30. We had a bullish crossover in the MACD. That is where we bounced in terms of the Fibonacci's there as well. So, very interesting. I think support level is starting to climb a bit higher, but really concerned about that resistance level that's sitting around 260, and we're not too far from there. So, not crazy about adding any shares of Amazon right here. How about Meta? So Meta, originally gearing up for this video here, gave them a B-, and this is a stock that I've added to at least 3 times so far in 2026 that I can recall. But Meta is a company that obviously is spending a lot of money. And as investors, we want to see it start to pay off. We want to see it start to pay off in terms of growth. We want to see it start to pay off in terms of operating income. We want to see it start to pay off in terms of efficiency when it comes to margins and things like that. Sometimes it doesn't happen as fast as investors want, and that's okay. You have to have a trust in when it comes to the management team. I trust the likes of Alphabet. I trust the likes of Amazon, both of them, a lot more than I do Meta, because we have seen this company light cash on fire and have nothing to show for it when it comes to the metaverse, which they don't even do anymore. So I moved my rating down to a C+. So I've added to it a number of times, but I want to take a wait and see approach. I continue to believe that this is a company that's going to increase in value. I believe the valuation is actually rather intriguing, but since I've done, for me personally, I've already added to it 3 times on the dips, and they were great times to add because you can see circled there is where those dips are, and we're seeing a support level start to increase, still believing in it, but now taking a wait and see approach over the course of the next few quarters here. So looking at the chart, we could see those areas of resistance that are sitting right around that 680 level, and the support levels are down there in that 545 range per se. But pretty self-explanatory. When we see the MACD that's at extreme heights and there's a bearish crossover combined with, at the top of your screen, RSI that's up over around 70 or above 70, not a time to own and be buying Meta. It's a time to be selling covered calls in the position. But vice versa, when we see the bullish crossovers, that's been the times to purchase the shares. And right now we are sitting at a MACD that is at the highest level that we have seen. We are looking at an RSI that is elevated as well, and the stock trading seemingly around that area of resistance. Wait and see approach. This isn't a spot I want to be adding to shares of Meta. All right, so now let's move on to Apple. We just have a few stocks left. So Apple has an edge score of 57. I give the stock a B+. Why? Because it has a fantastic balance sheet, a very strong balance sheet. They have a huge ecosystem, as we know, but I really think, they've been sitting on the sidelines when it comes to AI spending, and I think they're going to end up being one of the winners because they're going to find someone to partner with, whether it's Alphabet's Gemini, whether it's OpenAI, ChatGPT, or Anthropic, whatever the case may be. And I can see a situation where Apple starts charging subscription fees to utilize some of these AI fees. Now, some of these AI features, that could just be me in the dark, but that's just what I'm envisioning when it comes to Apple down the road. But in terms of valuation, 10% growth at 34.5 times, a little too rich for my blood for that lack of growth. Stock trading at an all-time high. You can see anytime that RSI is up high, the stock has peaked and in the short term has fallen. So right now, all-time high, RSI is high, MACD is high. It's just not one I'm looking to get into at these levels. Next is going to be Alphabet. Final stock on our list here today of the 11 stocks. Great company. I think it's more fairly valued now. So, back in April of 2025, I was pounding the table inside of my investing community. A stock that was way too cheap, valuations that just seemingly didn't make sense, growth factors that I thought were going to actually come in much higher. That's how it played out. And make sure you're part of our investing community because you're going to get my daily market reports. You get our weekly edge reports. And when I'm buying and selling stocks, options, and things like that, there's a link down in the description below. But no longer is it trading at 15.5 times. Today it trades at 24 times, giving you 13% growth expected next year, although I think that still could be a little flat. But over the course of the past month, the stock has pulled back just a little, down 5%. But again, this is my largest holding in my portfolio. And when we look here, you can see it's kind of been in a little bit of a downtrend, as I mentioned, down just 5% in the past month here. But I would be looking down here at that red line, which happens to be the 200-day moving average when it comes to Alphabet there. So that would be my buy target with Alphabet. So that is the 11 stocks. Next week isn't going to get any easier. Volatility will remain high as we go even further in depth into our Q2 earnings season. Here's all the stocks I would be watching. We get our first couple mega cap companies in terms of Tesla, Alphabet, in terms of Mag 7, Intel, IBM, ServiceNow, DR Horton. All of these are companies, whether I own them or not, they can give me intel. Like American Express, for example, can give me intel into the consumer. ServiceNow is going to give us, okay, how is this software trade doing in this world of AI? So those are all stocks I'll be watching quite closely. Really interesting on seeing how are the next, week or 2 weeks going to go in terms of the situation in Iran. This is a tweet that came out just today where a massive offensive approach, bombing and things like that could be gearing up to take place between the U.S. and Iran. So definitely going to see the impacts if that comes to fruition. Is that going to send volatility? Yes. Is that going to send growth stocks down? Yes. Could that have implications on inflation? Higher oil back towards 100? Yes, yes, and yes. But when you do your homework ahead of time, find the companies that you want to buy and the targets you want to buy them at. Don't rush. Don't chase stocks, but you find high quality assets at great valuations. We've already seen big pullbacks in a number of these companies. nibble dollar cost average into them, and start building out your portfolio the way that you want it to be. So that is the brand new series that we have started today. Make sure you let me know down in the comment section your thoughts of it, and then also make sure you smash that like button. We would love to see you inside the Full Stack Options Investor. That'll be starting on Tuesday, July 21st, 7 p.m. Eastern Time. Each Tuesday we'll be having our live sessions, and it's hands-on for 30 days. You get access to my Options Edge Plus. We'll be talking about stocks, not only talking about trades that I'm in, but also talking about trades that are potentially gearing up too. And my whole goal, as I mentioned to you earlier, is to earn your investment back with trades, brand new trades that we enter into during those 30 days. So thanks so much for joining today. Again, I hope you enjoyed this new format. Let me know down in the comment section, and we'll see you in the next one. Take care.